This is The Chris Berry Show. Expert information on elder law, retirement, and estate planning. Information that you can understand. Here's your host, Chris Berry.
Welcome to The Chris Berry Show. I'm Chris Berry, and every Sunday at 2 p.m. we talk wealth, estate, and tax planning for the second half of life. And so every show we like to start with what we call a positive focus, something that happened during this previous week, something positive. I like to always start off on a good foot. And this week, my positive focus was that I got to spend some time with my son. We had a Daddy Sunday, which we don't do enough. My son Ryan, he's 7, about to turn 8, and I have a 5-year-old daughter, Madison. This Wednesday, kind of took a day off work and played hooky and was able to spend some quality time with him. And we started off with breakfast. We went to Big Boy's, where he loves to have his Belgian waffles, and I had my omelet, and then we followed that up by visiting my wife, Ro, at her work, surprising her at work, and so that was exciting. And then we were able to, from there, we went bowling. It was his choice. We were kind of letting him pick the day, so we went bowling. Of course, I beat him both games. Just need to remind him who the boss is. And then it was pretty fun. His next activity that he wanted to do was we went to this ceramic place where you can pick out a ceramic item, and then you get a chance to paint it. And so I picked a little garden gnome. We have some garden gnomes in front of our house. And he picked out a mug with a dragon. And it was pretty cool seeing his creativity come through. And then from there, we went back to the house, and we took the kayaks out and stand-up paddleboard and played on the lake some. So it was great to spend some quality time with my son. It's something that just him and I, we don't get enough time to bond like that. So it was great to be able to do that. So it was pretty exciting. That was my positive focus for the week. And so today, what we're going to talk about on the Chris Berry Show, we're going to get into, in the second segment, we're going to start talking about some retirement account basics. Just understanding the basics of retirement accounts, retirement planning, how those different accounts work, the differences between a 401k, an IRA, and a Roth 401k. We're going to get into all of those differences. And then in the third segment, what we're going to do is answer some of our listeners' questions. So if you do have questions, you can submit questions anytime by emailing us at askchris@thechrisberryshow.com, or you can call us anytime at 810-355-2584, and some of our listeners' questions we'll get a chance to read on the air. So that's going to be our third segment. And then next week, we're going to get into some more advanced planning topics with regards to IRAs. One of the things I'm doing this week is going to Chicago, taking some time out of the office to learn from one of the IRA experts, Ed Slott, who's been on NPR. He's been called the IRA guru by the Wall Street Journal. So I'm going to do a 2-day training with Ed Slott, and I'm going to bring back some of those concepts to share with the listeners of the Chris Berry Show. So we're going to do a deeper dive into IRAs and retirement planning next week, but I thought this week we should probably start with just understanding the basics of what are the differences between an IRA, 401k, Roth, etc. And then next week, we'll get into some more advanced planning around those topics. And then I just came back, if you listened to the show last week, I just came back from St. Louis, where I did a training with some national experts as it relates to long-term care planning. Specifically what's called asset-based long-term care, where we can create tax-free money using governmental programs as well as assets to create long-term care leverage to protect your assets from the devastating cost of long-term care. And so one of the things I'm offering this week to the first 20 people that either call in or email us, you can request a copy of a book that I contributed to. It's called Tax-Free Money for Long-Term Care. Tax-free money for long-term care. So if you're interested in a copy of that book, we'll ship that out to you at no cost. but only for the first 20 people. So if you are interested in that tax-free money for long-term care, and I'm going to talk about some of the things in that book in this first segment, but if you are interested in that tax-free money for long-term care book, then give us a call at 810-355-2584. Again, 810-355-2584, or shoot us an email at askchris@thechrisberryshow.com. And when you do call in, if you could leave your full name and address, we will then send out a copy of the tax-free money for long-term care. But it's limited to the first 20 listeners of The Chris Berry Show. So be sure to pick up the phone or email us at askchris@thechrisberryshow.com if you do want a copy of that tax-free money for long-term care. And so what I want to do now is kind of talk about some of the concepts we talk about in that book, Tax-Free Money for Long-Term Care. And one of the things that we talk about is that the federal government has given us some incentives to look at purchasing long-term care. Because understand that if everyone goes on to Medicaid and with Medicare, there's costs associated with that. And the government needs to pay for that somehow. So what they're trying to do is incentivize individuals instead of relying on the federal government to basically kind of take it into their own hands, take responsibility for themselves. So the government has some kind of incentives for people. And one of those things that we have is what's called the Pension Protection Act. Pension Protection Act. And the important pieces of this act went into effect in 2010. And it's something that's important to understand. And if you're working with an advisor or attorney and he hasn't talked to you about the Pension Protection Act, you might want to second guess that relationship. So what the Pension Protection Act allows you to do is withdraw cash value from life insurance or funds from existing annuity tax-free to buy long-term care insurance. And it's completely exchange, or you can completely exchange an existing annuity for a long-term care policy on a tax-free basis. And basically what it allows you to do is access funds from certain types of long-term care annuities tax-free to pay for long-term care. So really, if you have an existing life insurance policy or annuity, especially one that you've had for a while, there's some pretty cool things where on a tax-free basis, we can then leverage that to be able to pay for long-term care tax-free. So what I thought I would do is share a couple examples or case studies of how this might work. So in our first example, let's take Bob. And let's say Bob is age 70. He's recently widowed. He has adult children that live out of town, cares deeply about remaining in his own home. He has some health concerns, but they're controlled. He has controlled diabetes with a history of heart disease. And he's been turned down for traditional long-term care insurance by long-term care insurance companies. So in Bob, he has $300,000 from the sale of his business. He has about $37,000 sitting in his checking. And he has an annuity valued at $100,000 already. So what might we do in Bob's situation? Well, what we can do is we can take a look at that. He has an annuity valued at $200,000 already. So what we can do is we can leverage that annuity that he already has, that's $200,000. What we can do is a tax-free exchange using the Pension Protection Act. And now that annuity could be valued at $1.1 million worth of long-term care benefit. So we could create a bucket of long-term care money over $1 million. And this could be used to pay for home health care, assisted living, or skilled care. So basically, he could create a tax-free stream of long-term care income of $8,300 a month benefit tax-free to pay for home health care, assisted living, or skilled care. Basically, money to keep Bob at home, or if he needs to go into assisted living, he would be able to do that. So that's just one example of using that Pension Protection Act where we take Bob's existing annuity and leverage that for long-term care, where we created over $1 million of long-term care protection that Bob did not have previously. So that's just one example. And if you want to hear more examples, we'll go over a couple more. But if you want a copy to see this in print of our book, Tax-Free Money for Long-Term Care, give us a call at 810-355-2584 to request a copy. Make sure to leave your full name and address, and we'll put one in the mail for you. Or shoot us an email at askchris@thechrisberryshow.com. Now, this is limited to the first 20 people that request a copy of that book. So can't give it to everyone. So be sure to pick up the phone or shoot that email as soon as possible. Now, the next example, we're going to take a look at Mary. So let's say Mary, she's age 60. Mary has a history of Alzheimer's disease in her family, and she has $250,000 of IRA money. She has $300,000 of checking and CDs, and then another $300,000 in stocks and bonds. And don't get hung up on the numbers. You might have more, you might have less. What's important is the strategy here. So what might we do in Mary's situation? Well, in Mary's situation, what we could do is we could look at moving from the CDs and checking. She had $300,000. What we could do is we could move $250,000, transition that, and now that $250,000 could be over $450,000 of tax-free money for long-term care. Or if she were to pass away peacefully in your sleep, and this is one of the nice things about the asset-based long-term care, is that if you don't need it for long-term care and you pass away peacefully in your sleep, it's going to be a death benefit to your loved ones and your beneficiaries. So by Mary transferring that $250,000 into an asset-based long-term care strategy, that $250,000 now became $450,000 of tax-free money for long-term care or a death benefit. Basically, by transitioning her money, she has a $9,000 a month benefit paid tax-free for home health care, assisted living, and skilled care. And then the great thing about this is if Mary decides to change her mind and say, you know what, I want to redo on this, I want to do something different, there's a full 100% full refund of premium that's available. So it's a way to again, Mary is able to leverage her money to pay for long-term care in a tax-free manner. So that's the second example of ways that we can leverage your money to pay for long-term care on a tax-free basis. So if you want more information to see this in print and you want a copy of our book, Tax-Free Money for Long-Term Care, the first 20 listeners to The Chris Berry Show, if you call in at 810-355-2584 or email us at askchris@thechrisberryshow, we'll get you a copy of that book. We'll send it right off in the mail for you. And now for the third example, we're going to look at Patty and Tim. Patty is age 63, and Tim is 68. Patty is frightened by the idea of going into a nursing home, and Tim is not a fan of traditional long-term care and would like to leave an inheritance to his children. And they have $700,000 of IRA money, and they have $37,000 of checking and CD and $20,000 in stocks and bonds. So what might we do in Patty and Tim's situation? Well, what we can do here is we can take $250,000 from Tim's current IRA, do a tax-free transfer to a new IRA that's 100% liquid, and that $250,000 can be leveraged for an unlimited long-term care pool of money, paying out over $8,000 a month for home health care, assisted living, or even skilled care. And also with this, there's 100% full refund of premium if Tim decides to change his mind. So we can put that IRA back if he decides that he doesn't want this long-term care benefit. So there's an unlimited pool of money where this $8,600 a month can be paid out for either Patty or Tim's care, or even both. So it could be paying out over, I can't really do math in my head, but almost $18,000 a month of benefits paid out. And then if neither of them need long-term care and they pass away peacefully in their sleep, upon the seconds of their deaths, $430,000 of death benefit, tax-free, could be paid out to their beneficiaries. Now, with this strategy, there would be an annual premium of $2,000 a year, which is a lot less than most of your traditional long-term care strategies or long-term care insurance. So it's a way that we can leverage their money to help pay for long-term care. Because if I were to ask Patty and Tim, if one of you had a stroke, where would you want to receive your care? They would probably say at home. And then if we were to ask, how would you want to pay for it? Well, their only option is that IRA. So what we've done is we've leveraged that IRA to now build in almost over $8,000 a month long-term care benefit that could help pay for home care, assisted living, or skilled care. And then if they change their mind, they can take the money back and put it back in the old IRA. So again, that's another strategy for paying for long-term care, using tax-free money to pay for long-term care and utilizing the Pension Protection Act. And if you want to see more information about these strategies and you want to see it in print, request a copy of our tax-free money for long-term care by calling us at 810-355-2584 or email us at any time at askchris@thechrisberryshow.com. And then join us in our next segment as we get into discussing some of the retirement account basics. We want to understand the different types of retirement accounts so that next week we can do a deeper dive into some of the more advanced retirement planning strategies, more of the advanced rules around IRAs and 401ks. And then join us in our third segment. In our third segment today, we're going to be answering some of our listeners' questions that they've submitted either via email or by calling in to the Chris Berry Show. So stick with us in our second segment. Again, you've been listening to the Chris Berry Show on FM 101.5, AM 1400 The Patriot, and then also via podcast as well. So you can listen to us on iTunes, or if you want to listen to any past shows, you can certainly listen to us on iTunes and download a listen. So join us after the break. Thank you.
The cost of long-term care can be overwhelming. If you're dealing with long-term care costs, make plans to attend the next free informative workshop from the Elder Care Firm in Brighton. They'll show you how to protect your hard-earned assets and obtain the governmental benefits you deserve, including veterans benefits and Medicaid.
Hello, I'm attorney Chris Berry. As the only certified elder law attorney in Livingston County, I have the knowledge and estate planning strategies to help you. When you call, reserve your seat at our next workshop or schedule a free 15-minute phone consultation. The Elder Care Firm is here to help you and your family find solutions. Call us today.
Spots are filling up for the next free Elder Care Firm workshop. Reserve your seat today by calling 810-214-3800 or visit theeldercarefirm.com. The Elder Care Firm also invites you to join them at this year's Walk to End Alzheimer's. The walk is on Saturday, October 1st in downtown Brighton. Call 810-214-3800 today.
And welcome back to the Chris Berry Show. This is your host, Chris Berry, where we talk wealth, estate, and tax planning for the second half of life. In our last segment, we discussed some asset-based long-term care strategies and also offered up a free copy of my book, Tax-Free Money for Long-Term Care. And so for the first 20 listeners, again, if you want a copy of that, you can email us at askchris@thechrisberryshow.com or leave us a message at 810-355-2584, and we'll get the copy of those books out to the first 20 individuals that request a copy. It's a great resource planning for long-term care, to use the Pension Protection Act and also use tax-free money to pay for long-term care. And now what we're going to get into is we're going to talk about some of the basics of retirement accounts. And then our third segment, we're going to answer our listeners' questions. And then also I just want to bring up, we're going to have some exciting guests coming to the Chris Berry Show. We're going to have Andrew, CEO, who's going to talk to us about liability, about the need for umbrella policy, looking at property and casualty in a unique way. And then also we're going to have Kathy Schaefer coming on. She's really an expert in the elder care journey of looking at assisted living and just kind of navigating that long-term care journey. And then coming up in September, I'm excited to have Maggie Gibbons back on the show talking about Alzheimer's Association, as well as talking about the Walk to End Alzheimer's, which is going to be occurring September 29th. We're always a big supporter of the walk. I serve on the committee that organizes that walk to end Alzheimer's. Last year, we raised, as a walk, over $137,000 going towards the Alzheimer's Association to help with the fight to end Alzheimer's. And this year we're looking to raise even more money. So if it's something that you're interested in supporting, you can go to thechrisberryshow.com and click through. There's a link where you can donate to the cause, or you can even join our team, be a member of our walk team. Last year, our team, we raised the most for our walk. We raised over $11,000. So it's something that's affected my family and affected my clients. And it's something that's very dear to my heart, that walk to end Alzheimer's. So in September, we're going to have Maggie Gibbons talking about the walk. And then we might have another member from the walk committee also talking about the walk. So we're pretty excited about that. So we have some exciting guests coming to the Chris Berry Show. So if you get bored of my voice, you're going to have a break. There's going to be some other voices on the show coming up. So that should be pretty exciting. Okay. So now let's get into kind of the basics of retirement accounts, because next week we're gonna talk about some advanced topics. So I want to make sure that we at least have a baseline of knowledge, and that's really our approach. We're all about education. My firm, we do weekly workshops educating the public and our clients on different topics as it relates to legal and financial and tax planning for the second half of life. And the workshops are typically at one of our four locations around Metro Detroit, Brighton, Livonia, Novi, and Bloomfield Hills. And if you do want more information on attending one of our free workshops, it's free to the public. You do have to RSVP, though, but you can do so by request some more information on that by emailing us at askchris@thechrisberryshow.com and just ask for a workshop, or give us a call at 810-355-2584. And we do these workshops about once a week at our different locations around Metro Detroit. So again, we're big believers in education. That's why I've taken time to write books on these topics. That's why we do this weekly show, really to provide education. So today the education we're going to provide is on just the basics of retirement accounts. And there's what's called tax advantage plans, and then types of plans that can grow tax-free. So probably the most common one that you've heard of is what's called an individual retirement accounts, or the acronym most people use is IRA. And IRAs give people a way to build tax-deferred savings for retirement. A lot of people mistake an IRA as a form of investment. It's not. What it is a wrapper that holds investments. You can basically put whatever you want inside of an IRA. It could be stocks, CDs, mutual funds, cash, bonds, basically anything except options and derivatives. Some people even have real estate inside of their IRAs. And so with the IRAs, a lot of times they haven't started as an IRA. They actually started as a 401k. So at your work, you might have what's called a 401k. And that refers to the tax code. But what happens with that 401k is that you can put in money, and that money goes in, and you don't pay any income tax when the money goes in. But when you take the money out, that's when you pay the tax. So it's a way that you can save money on a tax-deferred basis for retirement. Basically, you don't pay the tax now, you pay the tax later. And really, the 401ks, they came into being because more and more companies were getting away from the pension route. In the past, a lot of companies offered pensions. But now they've kind of shifted the responsibility and the onus to the individual worker to manage their own savings. And this is what the 401k is really a form of savings in a tax-deferred way. And then typically what an employer will do with these 401ks is they may offer some type of match. So if you put in a certain percentage, then they might match half up to, say, 6%, for example. So they'll match up to a certain point whatever your contribution is, basically rewarding you for saving money. And I'm a big fan of that. Basically, that match is free money. So if your employer is offering a match, at least contribute to that 401k up to the match. Maybe not go over it because there's some other things you can do with your money, but at least take that 401k up to that match in terms of saving. And again, it's going to be money that's going to grow on a tax-deferred basis. So the money goes in tax-free, but when you take the money out, so in retirement, as you draw from these plans, you have to pay income tax on that. And so a lot of people will have a 401k, but then when they leave that employer, most people don't want to leave their money at an employer they no longer work for. So what they'll do is then they'll roll it into an IRA. And that's probably the most common account, is that individual retirement account, that IRA. Now, there's some kind of key things to think about with regards to the IRAs. So the first thing is that you really cannot take the money out of that account prior to 59 and a half. There's a couple exclusions to that rule, but as a general rule, you cannot take the money out prior to 59 and a half without paying a penalty. And then also what happens is that at age 70 and a half, something needs to happen. And what needs to happen is what's called a required minimum distribution. So basically, the government's telling you that you're not going to be able to keep this money tax deferred forever. You have to pay the tax at some point. And so what the government says is that if you must begin taking distributions by April 1st, following the year in which you turn 70 and a half. So there's kind of some time constraints on these retirement accounts, meaning if you take the money out prior to 59 and a half, you're going to get hit with a 10% penalty, and then you have to start taking money out at 70 and a half. You have to take out, to start, 3.65%. So again, there's some kind of rules around the IRA, but it's a way to build money tax on a tax-deferred basis. Now, in addition to the traditional IRAs and 401ks, we also have what's called Roth IRAs and Roth 401ks. Now, the difference between the two is that with the Roth IRA, the contributions to Roth are never tax deductible, meaning you have to pay the income tax on them. But this is the magic part. The earnings grow tax-free. So think of it, would you rather pay tax on the seed or the harvest? And also the nice thing about the Roth is you may withdraw your contributions at any time without penalty. In addition, there's no requirement that you take minimum distributions at any age. Now, there's contribution limits on both the IRAs and the 401ks, which could be $5,500 per month or $6,500 per month. So you can have your own 401k or Roth 401k, but then also you can contribute. And there's some income requirements around that as well. But with the Roth IRAs, it's a great option. And now what a lot of employers are starting to offer now is what's called a Roth 401k. So it's a way that you can contribute at your employer to a 401k, but instead of it being on a tax-deferred basis, you're going to pay the income tax now on it, and it's going to grow tax-free. And I think that's a great option if your employer offers that. Because a question that we've asked many times on the show is, do you think taxes are going to be higher or lower in the future? And so a lot of people think taxes are going to be higher in the future. And then if that's the case, it makes more sense to probably pay the tax now instead of later. So if your company does offer a Roth 401k option, I think it's something that's worth exploring. And now companies will do a match if you do contribute to the Roth 401k. However, they cannot put the contribution into the Roth. They have to put that into the traditional 401k. Still not a bad thing because it's free money, but just understand that money is going to be in the traditional 401k, not in the Roth IRA. So we've talked about 401ks, Roth 401ks, IRAs. Now we're going to talk about what's called a self-directed IRA. And this is an IRA that is set up at a brokerage. It's said to be self-directed. And you have the responsibility of deciding how the money will be invested, whether it's in stocks and bonds, mutual funds, CDs, even real estate. And you can set up a self-directed IRA basically with any brokerage. Just visit the website and follow the instructions, and it's going to follow the same rules as your traditional IRA. Then we have what's called a SEP IRA, or Simplified Employee Pension Plan. These are company-sponsored IRAs that can be opened by smaller businesses or even sole proprietors. Under a SEP IRA, an employer can contribute to his or her own retirement or to an employee's existing IRA. In the case of an employee, the account is owned and controlled by the employee, and the employer simply makes contributions to the financial institution where the account is held. So it gives employers flexibility for some of the smaller businesses out there. And then there's what's called a simple or a savings incentive match plan for employees, IRA. And this is a company-sponsored plan that's designed for small businesses of 100 or fewer employees who make a minimum of $5,000 each. And this plan can be set up at a designated financial institution chosen by the employees. And a simple plan is a savings incentive match plan for employees in which the employer makes matching or non-elective contributions. And then on top of these, we also have things like 403Bs, 457s. Those are similar types of plans, but typically done at nonprofits or educational institutions sometimes. So with all of these, we call these qualified accounts. So they're tax qualified, meaning there's some type of kind of tax advantage to these plans, whether money is in a Roth where the money grows tax-free, or the money is in a traditional account, IRA, where you pay the income tax when you take the money out. Now, another form of retirement plan is something called a LIRP, which is basically a life insurance retirement plan, where you look at putting money into cash value life insurance, and that money can grow tax-free, similar to a Roth, but there's no requirements with regards to taking that money out at 70 and a half, and also that money could be leveraged for long-term care. So that's also an option as well. And we might spend more time on another show kind of diving into that concept, because it's a great way to create money in retirement on a tax-free basis. So those are some of the basics with regards to retirement accounts. Really, if you sum it up, there's kind of two types of accounts. There's your IRAs and then your Roth options. Now, the IRAs, again, that's going to be money that you defer the tax, meaning you don't pay the tax immediately. You pay the tax when you take the money out of the account. The flip side of that is the Roth option, where you pay the tax now, and then when you take the money out, the money comes out tax-free. And the big thing to remember with those traditional IRAs is that you have some time limitations where if you take the money out prior to 59 and a half, with some exceptions, you're going to pay a 10% penalty, and you have to start taking out your required minimum distributions at age 70 and a half. So if you have large IRAs, those RMDs, required minimum distributions at 70 and a half, that's going to count as income, and it might raise your tax bracket. It might cause your Social Security to get taxed, along with if you have a pension. So that's where a lot of people find out that they thought they were going to be in a lower tax bracket in retirement, but because of these large RMDs, they're not. And we're going to spend some time next week talking about that idea, as well as some of the more advanced concepts regarding retirement planning. Like I said, I'm joining Ed Slotz, who's a national expert on these topics, and I'm going to bring back some of that knowledge for listeners of the Chris Berry Show next week. So make sure to join us next week as we dive deeper into the retirement accounts and retirement planning. And join us on the next segment where we're going to answer some of the listeners' questions. This has been the Chris Berry Show. Join us after the break. Thanks.
If you or a loved one is facing long-term care costs, make sure you talk with certified elder law attorney Chris Berry from the Elder Care Firm. He can help you, like he did Keith Gerard's family. Here's Keith.
Basically, it's my in-laws. They're both 90, and they can't live on their own or anything, and they don't have enough money to go in assisted living. we went to Chris Berry to get the VA benefits. And he said, well, we can get almost $2,000 a month, which they can put towards assisted living. It was a big relief. Most lawyers are pretty sharp, but Chris, he knows exactly his business. And it's a shame that these vets have to go through all these processes. But I guess we need people like Chris to help us out. He made it so easy for us.
Hello, I'm attorney Chris Berry. The Elder Care firm is here to help you and your family find solutions. Call us today.
Get the governmental benefits you deserve. The Elder Care firm is ready to help you. Visit theeldercarefirm.com today or call 810-214-3800.
Welcome back to the Chris Berry Show, where we talk wealth, estate, and tax planning for the second half of life. In our first segment today, we got into some tax-free money for long-term care strategies, talking about the Pension Protection Act, how the government has given us incentives to look at taking over the responsibility of planning for long-term care versus relying on the government and Medicaid and Medicare to take care of everything for us. And we're offering a free book to the listeners of the Chris Berry Show, a book I contributed to, called Tax-Free Money for Long-Term Care. To the first 20 listeners who call in at 810-355-2584 or email us at askchris@thechrisberryshow.com and just say that you're requesting a copy of the tax-free money for long-term care. Make sure to leave your first name, last name, and your address, and we'll send a copy within the next week. Again, if you do want a copy of that free tax-free money for long-term care, just give us a call or shoot us an email, and we'll put it in the mail for the first 20 listeners of the Chris Berry Show. And again, we're big believers in education. That's why we're offering up this free resource where if you are interested in learning more about the Pension Protection Act or tax-free money for long-term care, how we can leverage your assets to create tax-free money for long-term care, just request a copy of that book, Tax-Free Money for Long-Term Care. And then in our second segment, we got into covering some of the basics regarding retirement plans, just talking about the different options out there, very generally talking about the IRAs, the 401ks, the Roth IRAs, the Roth 401ks, self-directed IRAs, SEP IRAs, Simples, 403Bs, 457 LIRPs, just a whole soup of letters and acronyms. And so we try to kind of break that down to provide a good base level of knowledge, because next week we're going to dive a little bit deeper into some advanced retirement planning strategies. And some of these strategies are going to be coming from a colleague of mine, a national expert, Ed Slott, who you might have seen him on NPR or quoted in the Wall Street Journal. He's nationally recognized as one of the experts when it comes to retirement planning. So I'm excited to work with him this week in Chicago, and I'm going to bring back some of that knowledge and share it with the listeners here of the Chris Berry Show. So join us next week as we dive deeper into the retirement accounts, retirement planning strategies, and kind of taking into account taxes as well. He talks about the retirement savings tax time bomb and how to diffuse that. So we're going to get into some of those topics next week. I'm excited to travel to listen to Ed and share some of my learnings, some of that knowledge that I learned with the listeners of the Chris Berry Show. So make sure to join us next Sunday at 2 p.m. on FM 101.5, AM 1400, The Patriot, or you can download us via iTunes or going to thechrisberryshow.com, and you can listen to some of our past episodes as well, where we talk about long-term care, we talk about a tax-efficient retirement, we talk about some estate planning topics as well, the basics of estate planning, 10 gruesome estate planning mistakes. You're going to find all of that in our old shows. So there's quite a bit of knowledge that we've already booked on the Chris Berry Show. And I'm excited to bring on some partners in crime, some experts in the area. I'm excited to bring Andrew, CEO, who's going to talk to us about liability, kind of protecting ourselves from when life happens. And then Kathy Schaefer is going to talk to us a little bit about the elder care journey and looking at assisted living as an option. And then we're going to have Maggie Gibbons talking about the Alzheimer's Association. And I'm trying to secure a couple more guests. So you're going to hear more than just Chris Berry on the Chris Berry Show. And we've already had Maggie on once during Alzheimer's Awareness Month, where she talked about the Alzheimer's Walk, the Walk to End Alzheimer's. Again, this year it's going to be September 29th. We're looking to have, last year we had over 800 walkers for our walk. And granted, there's 600 different walks going on. But for our walk, we had over 800 walkers last year. This year, we're hoping to have over 1,000. And if you want more information or if you want to donate to the cause, visit thechrisberryshow.com and click through to the link talking about the Alzheimer's Association. And you can either donate or join our team right there. So in this segment, what I want to do is get into some of our listeners' questions. So every week, I want to make sure that we answer our listeners' questions, and you can submit a question anytime by calling 810-355-2584, and we'll take for most of those, we'll take a moment and read the questions on air and then answer them. Or you can email us at askchris@thechrisberryshow.com. So these are some of our listeners' questions. So the first question is, how do I void a power of attorney? And this is from Howard. And Howard asks, how do I void a power of attorney? My sister gave me power of attorney over her, but I don't want to serve and I didn't sign anything. Well, that's the thing with powers of attorney, or when you appoint someone to serve a role, is they don't necessarily have to serve that role. For example, whether it's a trustee, a personal representative, or a power of attorney. And that's why when we're sitting down with families and putting together a estate plan, we recommend that they discuss with the people they've appointed whether they even want to serve that role, and then just discuss what the responsibilities are. So, Howard, in your situation, you didn't sign anything. You didn't accept that role. That's something that's required in Michigan, is to actually act as a power of attorney. You need to sign accepting your role to act. And that's a change since 2012. 2012 updated their laws regarding 2012, Michigan updated their laws regarding financial powers of attorney. And one of the requirements is that the person who's serving as financial power of attorney needs to sign an acceptance page. And so, Howard, the fact that you didn't sign anything means that you're probably not serving as a power of attorney and you don't have to serve. And again, there's no legal authority that forces you to serve as a power of attorney or any other role in an estate plan if you don't want to. And so what happens then is that it just defaults to the next person, whoever that successor is. So hopefully your sister has a successor, but Howard, in your situation, you don't have to serve, and maybe you just write a letter or put it in writing and send it off to your sister as well. But I don't think that's necessary because you didn't sign that acceptance, and there's no duty for you to serve if you haven't accepted that role. So hopefully that was good news for you to make your life a little bit easier, Howard. Then the next question is from Ross. And what Ross asks is, when my uncle dies and leaves no will, who inherits his estate? He has 2 living sisters and 13 nieces and nephews. And I want to know, who does his estate go to? Okay, so we have an uncle. He has no estate plan. And when you have no will, no trust, and you have assets that end up going into probate court, we call that dying intestate. So that means you've died without a will. And so that means you're just relying on the government's rule book. You're just relying on the default rules of Michigan. So what would happen in this situation where the uncle dies, leaves no will, has no children? He has 2 living sisters and 13 nieces and nephews. So what happens is we follow the default rules of probate, of dying intestate. So first, if your uncle had children, it would go down to his children. If he doesn't have any children, then everything would go to his parents. And if your uncle doesn't have parents who are alive, then it goes to siblings. So in this situation, that's where the conversation would stop because he has 2 living sisters. So your uncle's estate, whatever happens to be in that estate, would be split 50-50 between the 2 living sisters. Now, if one of the sisters were to predecease, or if there was another sibling who had passed away prior, that share would go down to that deceased individual's children. So the only way in this situation that the nieces and nephews would be able to inherit anything would be if the siblings, your uncle's siblings, were to predecease. But based off your question, it sounds like there's just the 2 sisters. So based on what you provided here, Ross, it looks like the 2 sisters would split everything 50-50. So hopefully that was helpful. Hopefully that was the answer you were looking for. But that's why it's important to set up an estate plan to make sure that your stuff goes where it's supposed to go. We don't want to leave it up to the courts to decide. We don't want it to die intestate where now there's confusion. And that's why it's important to set up a strong estate plan that directs, first of all, that avoids probate, and then second of all, directs your stuff to go where it's supposed to go. It's better to create your own rule book than to rely on the government's rule book. So hopefully that was helpful, Ross. Now, our third question, and again, if you do have questions, you can submit questions to us at any time via email by going to askchris@thechrisberryshow.com or via the phone at 810-355-2584. So the third question we have this week: what should I do with my RMDs, my required minimum distributions, after I paid taxes and I have no need for the funds? And this is from Josh. It's important to me to leave money to my granddaughter and my grandson. I want something with limited risk. So it sounds like Josh has done a pretty good job during the accumulation phase of his life. He's been a good saver. Now he's over the age of 70 because he has to take, or 70 and a half because he has to take his required minimum distributions. If you remember from the previous segment, once you turn 70 and a half, you have to take out required minimum distributions. We call those RMDs, required minimum distributions. And basically it's a percentage. And at 70 and a half, you have to take out 3.65%. And then every year thereafter, the percentage actually goes up. And it's on an actuarial table with the IRS that assumes you're going to live to 115. So that's how they calculate your RMDs. So Josh is in a situation where it sounds like either through a Social Security and pension or other investments, he doesn't have to take out his RMD, or he does have to take out his RMDs, but he doesn't have a need for them. And he's looking for a way to maybe utilize this for the grandchildren. Well, there's a couple options here. Some of them simple, some of them are more complicated. So one thing you could do is just take those RMDs and you could either spend it on the grandkids, take them on trips, you could give it to them, but if you get into gifting issues, you can only gift $15,000 a year. That's your annual gift tax exclusion. Anything more than that would be potentially a gift tax issue. But again, you have a lifetime gift tax exclusion amount of over $11 million. So most likely you're not going to gift that much. So it's not really a gift issue. But there is kind of a tricky and a little more complicated, but a way to kind of leverage those required minimum distributions, especially if you happen to don't have any type of long-term care insurance. So one of the things you could do is look at permanent life insurance as an option on how to leverage those required minimum distributions. So let's say you have an RMD of $10,000 a year. Well, that $10,000 distribution you have to pay income tax on. But now what you could do is you could put that into a permanent life insurance policy that could grow tax-free, but also offer you a potential long-term care benefit. So if you were to need long-term care, that could be utilized for long-term care if you don't have any type of long-term care protection. And then if you were to pass away, then that could be, and I'm hoping you have some type of estate plan and hopefully a trust, that if you're to pass away, that death benefit, that leveraged death benefit could then go into a trust that could be utilized for the benefit of the granddaughter and grandson. I don't see an age for the grandchildren, so I don't know how old they are, but a trust would be a great option. And then that life insurance would be a way to leverage that money. So really kind of creating some growth, creating a legacy. And then you name the life insurance or name the trust as the beneficiary of the life insurance. And with that trust, we could protect the grandchildren from either their own poor financial mismanagement, especially if they're minors or they're young, or if they are older and they have good heads on their shoulders, we could protect the proceeds of that death benefit from the life insurance. We could protect that from the outside environment, protect from divorces, lawsuits, creditor actions, bankruptcy. So it's a little bit more complicated, but that's a great way to leave a legacy to the next generation. Something to think about, Josh, but I would suggest you sit down with a professional, and it's certainly something that we could help you with. So hopefully that was helpful. Now, our last question is, are CDs or a diversified mutual fund a better investment if I want to leave an inheritance to my children? This is from Darren. I have $70,000 sitting in savings that I'll not need to touch. How should I invest it for my children? Well, we subscribe to kind of the bucket plan approach of first figuring out when you plan to utilize this money. And it sounds like you don't plan on giving it to the children right away, but you want it to go to them upon death. So assuming that you're rather healthy and it's not going to happen the next year or two, I don't think CDs make the most sense because you have a little bit of a time horizon there. So I would maybe look at investing in a mutual fund. And that's just kind of general advice. If it was something within the next year or two, then maybe you look at CDs or the next couple of years. But if it's more than 5-10 years out, I would suggest looking maybe at a mutual fund. You're going to have a better return there. So hopefully that was helpful, Darren. And again, if you have questions, feel free to email or call us with those questions, and we read them on the air each week. You can call us at 810-355-2584 or shoot us an email at askchris@The Chris Berry Show. And again, this has been Chris Berry, where we talk wealth, estate, and tax planning for the second half of life. Please make sure to join us next week. And next week, we're going to get in some of the advanced topics regarding retirement planning. Going to visit Guru of Retirement Planning, Ed Slott, and I'm going to bring back some of that knowledge for our listeners. So make sure to join us next week on The Chris Berry Show. Make it a great week. I look forward to hearing you or you hearing me next week. Thank you very much.
Learn more about Chris Berry and the Elder Care Firm by visiting online at MichiganEstatePlanning.com. That's MichiganEstatePlanning.com. You can also call Chris Berry at 888-390-4360. 888-390-4360. This program content reflects the opinions of Chris Berry and his guests, not the Elder Care Firm, Prosperity Capital Advisors, or the C.J. Berry Group, and is subject to change at any time without notice. Content provided herein is for informational purposes only and should not be used or construed as investment or legal advice or a recommendation regarding the purchase or sale of any security or to follow any legal or tax strategy. There's no guarantee that the strategist's statements, opinions, or forecast provided herein will prove to be correct. Past performance is not a guarantee of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses, which would reduce returns. All investing involves risk, including the potential for loss of principal. There's no guarantee that any investment plan or strategy will be successful. We recommend that you consult with a professional dedicated to your needs. This program is furnished by the Elder Care Firm.
The cost of long-term care can be overwhelming. If you're dealing with long-term care costs, make plans to attend the next free informative workshop from the Elder Care Firm in Brighton. They'll show you how to protect your hard-earned assets and obtain the governmental benefits you deserve, including veterans benefits and Medicaid.
Hello, I'm attorney Chris Berry. As the only certified elder law attorney in Livingston County, I have the knowledge and estate planning strategies to help you. When you call, reserve your seat at our next workshop or schedule a free 15-minute phone consultation. The Elder Care Firm is here to help you and your family find solutions. Call us today.
Spots are filling up for the next free Elder Care Firm workshop. Reserve your seat today by calling 810-214-3800 or visit theeldercarefirm.com. The Elder Care Firm also invites you to join them for Excite Night at the Pound in downtown Brighton on Tuesday night, August 9th from 5 to 7. This is the kickoff event for this year's Walk to End Alzheimer's, coming up on October 1st. Call 810-214-3800 today.